Good Monday morning. Futures higher for this start of the week. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, the latest AI deal. IBM snaps up data streaming platform Confluent for $11 billion. It's one of IBM's largest takeovers yet.
And Trump throws cold water on Netflix's $72 billion Warner Brothers takeover. We'll explore what it means for Hollywood's biggest bet.
And Ed Yardeni says it's time to chill on Mag 7 stocks, warning margins are under attack as every company becomes a tech company.
I feel like it's every company wants to be a tech company. I don't know if they actually are. But on the big deal news of the morning, Matt, and really like of the week, of the month, maybe of this year, it is the drama between Netflix, Warner Brothers Discovery, and all the other bidders, because President Trump has raised potential antitrust concerns around Netflix's planned acquisition of Warner Brothers. He noted that the market share of the combined companies may pose problems, also confirming our earlier reporting that he had talked to Ted Sarandos, Netflix CEO, came and tried to get a blessing of the deal.
Yeah, it's so interesting because what is it, like 7-8 years ago, we were doing the same thing with AT&T and these very same assets, and President Trump was very much against that. We'll see how he feels about this and how the Justice Department feels. IBM will buy data infrastructure giant Confluent for $31 a share in cash and help it power AI applications and agents. Confluent's platform helps companies gather and analyze data in real time. Right now, we see IBM shares trading down just a little bit, but a huge jump, obviously, given that premium for Confluent. Dani?
Let's get back to the Netflix story, Matt, because as I said, President Trump weighed in on the potential deal with Warner Brothers. Let's listen to what the president said.
But he's done one of the greatest jobs in the history of movies and other things. He's got a lot of interesting things happening aside from what you're talking about. But it is a big market share. There's no question about it. It could be a problem.
Trump talking about the Netflix CEO in those comments. For more on this deal, we're joined by Bloomberg Intelligence media analyst Geetha Ranganathan. Geetha, President Trump specifically talking about Netflix. Is there any reason that the president would be more concerned with a Netflix takeover than, say, a Paramount buying of Warner Brothers Discovery?
So, the assets and Matt just brought up the CNN or rather the AT&T Time Warner deal a few years ago. And I think why President Trump was so opposed to that deal was because of the inclusion of the CNN networks. Now, in the Netflix Warner Brothers deal, there is no TV networks. So one would think that this should really not pose so much of a problem as far as President Trump is concerned. That said, he did raise the question of market concentration, and he's absolutely right. Netflix has over 300 million streamers. HBO Max has 120, 130 million. So yes, this does make up majority of the market. Again, there's always the question with Paramount Skydance. We know that the Ellisons are, friends of the Trump administration. That deal actually, or that bid rather, includes a deal for all of Warner Brothers Discovery, which is both the streaming and studio as well as the TV networks. And I think there has been some promise by the Ellisons that, CNN would probably have a more conservative stance once it comes under their control. But again, this is really going to be a very, very long road, Dani.
Yeah, it does seem like, look, Netflix, rightly or wrongly, is seen as a more liberal, globalist company with the support of, DEI policies, LGBTQ programming. And, of course, the Ellisons have a longstanding history with the Trump family. Larry Ellison and Donald Trump have been close and been doing deals already this year. What can Ted Sarandos do to convince the Trump White House that it is an ally?
I mean, they've already said all the right things, Matt. So, they've spoken about keeping the two platforms separate as of right now, meaning Netflix and HBO Max, which means that, there's enough consumer choice. They are also talking about making this pro-consumer from a pricing standpoint, as in reducing the price, offering bundles, potentially cutting the price by 30, 40, 45%, making it more, wallet friendly. As far as, a reduction of theatrical output, I mean, this is the big concern with Netflix. Will they reduce the number of movies that come out in theaters? And they've said so far, again, they've said They've promised to honor all of Warner Brothers' commitments, keep doing the theatrical release as initially planned by Warner Brothers. And then again, the other thing is Warner Brothers, of course, has a huge licensing business. 40% of their studio revenue actually comes from licensing content like Ted Lasso, content like The Voice, to all of these other platforms. And so the question is, will Netflix then curb that licensing? And again, they've gone out and basically said that they will not do that. So, so far they seem to be saying and doing all the right things. Of course, we don't know how everything is going to pan out just yet.
Right. Well, we're just getting headlines, Geetha. I know you got to run, but Paramount is offering a $30 all-cash offer and saying that the equities be backstopped by the Ellison family. So Paramount offering to buy Warner Brothers for $30 a share in cash, as had been reported. Remember, the Netflix deal is for $27.75, and that's cash in stock. But of course, Paramount wants to buy the entire company, and Netflix looking to split them up. So, or Warner Brothers Discovery would split up before the Netflix deal. I think this is interesting because the Paramount offer isn't just the $30 a share, right? If Warner Brothers goes with Paramount, they'll also get a $5 billion breakup fee from Netflix. Is that right, Geetha?
Yeah, 5.8 billion to be exact. But the thing is, on the immediate face of it, Matt, the $30 is actually lower than what Netflix is offering. So Netflix, yes, they did offer 27.75 for the studio and streaming, but there is still some inherent value in the Discovery Global TV units. We calculate that to be about $4 a share. So you have the total value of Warner Brothers Discovery there at $32. So again, that offer is still superior to this Paramount offer at $30.
All right, Geetha, thanks very much. Geetha Ranganathan there of Bloomberg Intelligence. She's got to get cracking on these new headlines. We will speak, by the way, with Michael Wolff, Activate co-founder and CEO, in the next hour. Of course, he used to run MTV as well. He can talk to us about the industry on which he's an expert, some of the regulatory issues surrounding this deal. Now, Jamie Dimon is warning that Europe's slow bureaucracy has driven business investment and innovation out, thereby posing a risk to Europe's growth, its ability to finance itself, and hence our stability as an ally. He spoke at the Reagan National Defense Forum.
We need a long-term strategy to help them become strong. A weak Europe is bad for us, it's bad for the civilized world, it's bad for the free and democratic world.
Bloomberg Caroline Hyde conducted that interview and joins us now, and you have to kind of connect the dots to understand his argument, which is that a weaker Europe is bad for the U.S. and therefore bad for the entire Western world, right? As I guess we look at kind of the West versus the East.
And this call comes hot off the heels of what took Europe by shock in the last few weeks, whether or not it's once again in the line of fire is a deal between Ukraine and Russia and what that deal looks like and how much Europe has any sort of say at the table. But more brutally has just come for them is the National Strategic Review. It's basically their national security strategy was put out by the United States administration and basically it lambasted Europe. And it was saying you need to get yourself together, whether or not it's about the way in which you are running yourselves, your economies, but more broadly how you're taking on certain wars and endeavors. And it really started to talk about Europe even as a civilization. This was a shock to Europe, and this was what the question I put to Jamie Dimon. Is tough love from the United States what Europe needs? Because Jamie has written about this in prior annual reports, saying really what we need right now is the US to help Europe, not to hinder it. And so I think his key point is, yes, we need them to change. We need them to regroup. We need them to be more innovative, more business friendly, more focused on their own defense spending. But he was perhaps trying to put out there that is tough love really the answer here, because we need them to be non-fragmented. If they fragment, so too does the entire ideal of America first.
Even so, where he's investing, I mean, yes, he has invested some in Europe, but this new security and resiliency initiative that JPMorgan has, they launched it in October. But we learned today that they've hired Todd Combs from Berkshire Hathaway. This feels like a big get for JPMorgan and a big loss for Berkshire Hathaway.
And overall, we've seen Todd on their board for a while. So it's a close relationship that he's had with JPMorgan. And indeed, Berkshire Hathaway are doing a lot of changes, aren't they? The CFO is changing. They're having just a new plan as they think about what it looks like with Warren Buffett moving on. But what's interesting about JPMorgan is that they're really trying to say, look, this $1.5 trillion initiative with which there's going to be $10 billion of equity spending, venture investment. Who's going to be overseeing that? So Todd Combs is going to be coming in and be heading up really the investment strategy, but he's going to be on a, sort of a right-hand person to Jamie Dimon, going to be there at the table, giving him strategic advice. But then it's where does the money get allocated? For that, they've got an even wider council. They're turning to the likes of Jeff Bezos. They're looking to Michael Dell. They've got Condoleezza Rice. They've got the ex-J&J CEO, all coming on board to think about national security, not only from defense spending, tech spending, but more and AI. And you'll have Jamie Dimon thinking a lot about potentially a federal view on AI more broadly and not state by state. But also, what are they going to think about? US's dependence on China for all pharmaceuticals. This is a holistic approach coming from Jamie Dimon, from JPMorgan. $1.5 trillion was up by 50% of what they thought they were already allocating to national security resiliency more broadly.
Yeah, and again, I just wonder what the future of Berkshire Hathaway is after Warren Buffett if he's losing key lieutenants like that. Caroline, thank you so much. A fantastic conversation with Jamie Dimon, Bloomberg's Caroline Hyde. Now, we have a lot of AI deals to kick off the week, but one of the larger ones, IBM buying data streaming platform Confluent in a deal valued at $11 billion. The companies say that the deal is expected to close in the middle of next year. IBM shares are just slightly down on the news, down 1/10. Confluent trading closer to its offer price of $31. For more on this deal, we are joined by Anurag Rana, Senior Equity Research Analyst at Bloomberg Intelligence. Anurag, first of all, what in the world is a data streaming company, and what difference does it make to AI? Why would IBM want this?
Yeah, if you think about it from IBM's point of view, they have been expanding their software deals, ever since they really bought Red Hat. Now, particularly this company is a platform for data streaming. So, when you have, it could just be your transaction, financial transactions, or it could be data that's coming from sensors. Now, when you're thinking about AI applications on an enterprise, you want real-time data because that makes a lot of sense of what's happening. So if the CEO wants to know what's happening in terms of my sales pipeline or anything when it relates to streaming data or even oil and gas, think about it from that point of view. We are in the world of IoT. So this thing does make sense for them. The math works. It's not that expensive. The company is growing at about 17 to 20%. So I think all in all, strategically a good fit, financially a good fit.
All right, Anurag, thanks very much. Anurag Rana there talking to us about the IBM deal. We're going to continue to cover that story on this M&A Monday. Just looking here at the Paramount offer, again, for Warner Brothers Discovery. Paramount says it would be an enterprise value of $108.4 billion. I think that's so fascinating because this is an asset that AT&T bought for $87 billion in 2018. So you've got that. Also, the banks are going to come in with $54 billion of debt commitments, and it is going to be an all-cash deal. And
I think one of the key things about this, too, is they're taking it directly to shareholders. This is, in essence, a hostile bid for Warner Brothers Discovery now, after they already agreed something with Netflix. So it just means that this is going to get even more messy with Warner Brothers, or rather Paramount, insisting that their deal is a better one.
Yeah, they had agreed with Netflix, and what Bloomberg reported was Polymarket had 60% odds of this deal closing by the end, the Netflix purchase, by the end of 2026.
Right.
After President Trump's comments at the Kennedy Center yesterday, those odds plummeted to 23%.
Yeah.
So it's just Polymarket.
One sentence from Trump undoes the whole thing.
Yeah, well, it's two, I think, things. The first is the fact that he thinks maybe the market share is too big. The second is the fact that he vows to be personally involved.
True, yes.
In any decision. And I think maybe the second part
and he's close to the Ellisons, and Larry Ellison and David Ellison, and Paramount gives him a little bit of an edge.
All right, coming up, traders are rotating out of the concentrated AI stocks and into stocks that have been lagging in 2025. We're going to give you details of this trade next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. Ukrainian President Volodymyr Zelensky says the U.S. peace plan is stuck on the toughest issue: who controls the Donbass region, and warns that Ukraine still lacks firm Western security guarantees. His comments follow President Trump's public disappointment in Kiev's stance. Zelensky is now rushing to European leaders as divisions over the U.S. proposal deepen. Berkshire Hathaway is rolling out major leadership changes ahead of Warren Buffett's retirement next year. Longtime CFO Mark Hamburg will step down. Charles Chang is taking over in 2025. Nancy Pierce becomes CEO of Geico as Todd Combs departs for JPMorgan. Buffett also appointed new division leaders and will add a general counsel role as Greg Abel prepares to assume the helm. And we will have more on that Todd Combs JPMorgan story later on. Yardeni Research recommends going underweight the Magnificent Seven stocks versus the rest of the S&P 500. That's a dramatic shift from the veteran tech bull. He spoke with Bloomberg about the decision.
I've been recommending overweighting information technology communication service since 2010. The problem is it's worked all too well. The two sectors now account for a humongous 45% of the market cap of the S&P 500. Of course, their earnings share has also increased, but nowhere near as far. And the same thing can be said about looking at the U.S. versus the global economy. When you look at the U.S. MSCI relative to the world MSCI index, what you see is the U.S. now accounts for 65% of the market cap of the world stock market. So it's hard to recommend overweighting something that's already quite overweight. I mean, if you just told people just to maintain the current weight of the index, that would still be an overweight position relative to what most people would think would be a diversified portfolio.
Ed Yardeni on his new call. Let's discuss with Bloomberg macro strategist Michael Ball. So, Michael, two parts to it. One is like, it's working so well that it's dangerous, which I don't know about that one. And then the second one is that all the other companies in the S&P 500 are essentially becoming tech companies, so they should do better. Do you buy either of those arguments for a reason to underweight Mag 7?
Yeah, I mean, I guess two things to your point. One, we're moving on in the AI story, so now we're going to see if people can implement AI to get better profitability. So that makes sense that everything's becoming a tech story in some ways. And two, valuations, right? The concerns that drove sort of the November turbulence was really based on how much you want to pay and how long you're going to be patient to see the shareholder returns. That now has sort of settled down as we've come off of this sort of choppiness that we saw back then.
Can you look back at, the dawn of the internet for clues as to who will be the winners and losers at the dawn of AI?
No, I don't think so. I think this is different. I think, interestingly, the energy story, which had been sort of capping how large this pie can grow for AI CapEx, has now become a little better with the Amazon and Google developments, giving alternative chips, alternative avenues with less energy intensity. And I think, as you guys covered well for a while there, that was really a physical constraint on this growth and this valuation story.
The idea that AI makes everybody more productive, I mean, it's something that's been widely debated. I've got to say, it feels like companies just don't have this figured out. Yeah. That even if this is a story, I mean, how long will it take for it to make itself known that you could actually bet on it now?
Right. I think everyone wants an easy answer, but in actuality, it would be totally different. And when you bring in the automation of it and the physical world that has different complexities than just, say, being a paralegal replacement or looking for something at a mid-level management, it's totally different, and we're going to have ebbs and flows that we've talked about, and it's just going to be very volatile at points, but then it'll settle back down as we get a more positive narrative. And this is what markets do. They're kind of always looking up and down.
Can you just compare this, though, to like the gin mill or word processor? Like, there's been a lot of talk about Excel, right? And people freaked out about the fact that that was going to kill jobs. Yeah. We found other stuff for junior level employees to do.
You're right, and I think that's the rosy outlook, but the disruption, the question to your point is absolutely, history has shown that over a decade or 2 decades, this will probably work out well for the overall status of humanity and job growth. But the disruptions that are going to be caused is what people are worried about.
But OpenAI literally has been hiring bankers in order to build a product to specifically replace junior bankers. Right. I feel like Excel wasn't created to be like, who can we replace? It feels like that's exactly what these companies are doing, trying to zero in on how do we remove human capital and instead insert AI.
Well, and it's already happening, right? I mean, you're seeing consultancies that don't have as big a freshman class, law firms that don't have as big a freshman class. And not only does that matter now for college or grad school grads, but it matters down the line when you need, senior executives and no one's been trained.
Right, and also there's the in the office versus out of the office debate. There's the actual crypto, which
wasn't
is the
that
blockchain.
Debate settled in the office versus out of the office?
But do you have the soft skills? Because now you don't need the technical skills because AI is going to do that. So now you need people with varying skills that they may not have gotten the last couple of years because they've been absent from that kind of environment.
But again, it just comes back to these are huge narratives and we don't actually know where it's going to be. So like on a practical level, trying to invest on that feels like a fool's errand versus the Mag 7. They're spending a lot, so that's concerning. And by the way, a lot more debt. We're going to get Oracle earnings on Wednesday. Is there a chance that this could be extremely volatile, that they need to show up and justify the amount of spending that they've been doing?
I think for that single stock, potentially, yes. I think we've moved on as that is the bellwether for the rest of the AI CapEx story, which is interesting, right? In Core, we've just had an issuance today, which is convertibles, which then should dilute the shares as well. So overall, you've moved past sort of the weaker hands, stronger hands. And funny enough, Amazon and Google have enriched that by giving alternatives to just the OpenAI, NVIDIA sort of channel. So it's a healthy development in a lot of ways. But again, single stock volatility versus index vol being suppressed.
Michael, great to have you on, as always, as Bloomberg macro strategist Michael Ball. Coming up, we're going to catch up with BNY Wealth's Sinead Colton Grant, who joins us to share her bull case for 2026. This is Bloomberg Open Interest.
All right, we are looking at futures right now that are a bit higher. We closed the day out at 68.70 on the S&P on Friday, so it looks like we could extend those gains. In terms of some of the individual movers on our radar, Dani, what's
we're watching some of the ones that have been included into the S&P 500. That includes Carvana, CRH, and Comfort Systems. Google, Nextera, also looking at them. They've reached a deal to develop data centers paired with electronic plants in 3 undisclosed locations. Finally, Instacart is now available on OpenAI's ChatGPT. Shares of Instacart are higher. I don't know if that means that they need your credit card information to buy. I don't know what this means.
I believe it's just a link to Instacart. I mean,
that's kind of lame.
Yeah, it's not agentic.
Yeah, I wanted to
Yeah.
come up with a meal plan for me and then order all of my groceries. I think that would be ideal.
I'm right there with you. We'll get there soon enough. The bell on the other side of this break. This is Bloomberg. Moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. We are essentially 20 points away from an all-time closing high. As I said, 68.70 was the close on Friday. 68.90 is the all-time high on a closing basis from the end of October. So we could get there today. Right now, S&P futures are up 0.1%, not quite enough. NASDAQ futures are up 0.2%. If we see that kind of movement, it could help a little bit more. Down at the New York Stock Exchange, we've got John Deere ringing the opening bell. There's a bunch of smiling faces, not just because the stock has doubled over the last 5 years, and they're outperforming even the S&P by 1 percentage point and change, but also if farmers get money as part of this reported $12 billion package from the Trump administration, they're likely to funnel some of that money along to those guys over at Deere. LPL Financial ringing the opening bell down at the New York Stock Exchange. They brought a big group down to the marketplace. Why not, right? That's a bucket list moment, right? Ringing the opening bell.
I also think it like visually looks really nice. They're like one big happy family ringing the bell together. In terms of not one big happy family and a fight and a drama that continues, Matt and I were, thank you, Matt. Matt and I were talking about this about 30 minutes ago. The fact that you have Paramount Skydance now coming in, essentially is a hostile bid for Warner Brothers Discovery, because Warner Brothers already agreed to an acquisition by Netflix. Netflix, Trump was talking about that, throwing cold water on it, saying it might be a big problem because of market share. Well, Paramount comes in, says we're going to offer you $30 a share. Netflix's bid is $27.75 a share. Matt, just for a moment on the stock price reaction, I think it's notable that Paramount is rallying on this news, whereas every time we got close to Netflix buying Warner Brothers Discovery, shares sold off massively. So it just shows that the market thinks that this would be good for Paramount, bad for Netflix if it bought Warner Brothers Discovery.
Yeah, I think that is absolutely fascinating. We're going to continue to talk about this, cover this story, and talk about it. So we'll get more details on this emerging bid. IBM will buy data infrastructure giant Confluent for $31 a share in cash to help it power AI applications and the agents we keep talking about. Confluent's platform helps companies gather and analyze data in real time. Apparently, we don't the two of us, I think, know much about it, but we're learning today. We're learning what Confluent
Every day
does.
is a lesson.
It's an $11 billion deal, so just a tenth the size of the enterprise value of Warner Brothers Discovery. Oppenheimer's John Stoltzfus is yet again Wall Street's biggest bull. Stoltzfus expects the S&P 500 to trade around 8,100 by the end of 2026 on the back of robust economic growth and monetary policy easing. We want to bring in right now BNY Wealth Chief Investment Officer Sinead Colton Grant to talk about this. It would have sounded a little bit more insane if we hadn't gotten to basically 7,000 now at the end of 2025. What do you think the chances are of adding another 1,000 points, Sinead?
Well, look, we do think that innovation drives opportunity, and we're constructive. But we see for the upper end of our forecasts for 2026 to maybe about 7,500, 7,600 on the upper end. But look, there's a lot we don't know. That assumes we get double digits earnings growth. We've already seen over the last couple of years significant surprises in the tech sector. So it's not our forecast, but we are leaning in the same direction.
What about what gets us there? Because Ed Yardeni also had a call out over the weekend that got a lot of attention that he's now underweight Mag 7. The idea being that they've already run really far and everything else is becoming a tech company, so everything else should outperform. Do you expect leadership to also shift in 2026?
Well, we do expect that the gains will broaden, right? That we'll see better performance from the rest of the S&P. We like the tech sector, though. We still think that the fundamentals look strong, but there are other sectors that we favor as well. Industrials, we think clearly it's a good time from a cyclical perspective. Also, they're going to benefit from many of the AI adjacent trades. And financials too. So financials benefiting from a steeper yield curve and also some of the loosening of regulatory requirements that lead to more deals. You just spoke about a couple of big M&A opportunities already earlier in the program. So we think it's going to broaden, but don't count out tech. I think that's a very dangerous thing to do from a portfolio perspective right now.
Can I just ask about rates and how much it matters? That I'm looking at a chart of 1, 2, 3 rate cuts over the last year, and the 10-year yield has gone from 4.20 to where are we now? 4.15. So essentially stayed the same, even though we've cut out 75 basis points. Ed Harrison from the Macro View team here at Bloomberg argues that global rates are going to rise and pull U.S. yields with them. Is that a problem for stocks?
Well, look, the fundamentals that drive stocks are earnings and interest rates. And so what's most important is stability around the level of rates. Now, when we see the 10-year at these levels, we think 4 to 4.5% on the 10-year. Stocks can weather that very, very well. But look, what you've just pointed out, that's the very reason why you can have cuts from the Fed, but yet longer bond investors will make an assessment of the term premium, inflation expectations. We had the Michigan survey out last week. The 1-year inflation expectations are sitting at around 4%. 5 to 10-year are, still above 3. So it's not that they're seeing inflation getting back down to the Fed's target certainly in the short to medium term.
But this is an administration that as soon as they came in, especially with Scott Bessent at Treasury, has been our goal is to lower Treasury yields. If we do get in the scenario where we're saying that even if a Fed is cutting and you see long-term yields go higher, Peter Scheer points this out, that one of the things for 2026 that the market is underpricing is that this is an administration and in Treasury, maybe in concert with the Fed, will do basically whatever it takes to bring yields down. If we do get that sort of policy coming from the White House, just how do you think it impacts markets?
Well, let's think about the why, right? The why they want to keep yields lower is because of the level of outstanding debt and the cost of servicing that debt. Now, what they're doing right now is funding at the short end. That's where rates are lowest. There are many things that could lead to lower yields. We know the Fed is very focused on getting inflation back to the 2% level. And when you look at their projections, they see that over the next 2 to 3 year time horizon. I think that the biggest concern for the Fed would be if inflation expectations become unanchored, because that is the hardest to get back under control.
You've mentioned earnings. Obviously, that's the other piece of the puzzle here. Do you expect still to have double-digit earnings growth throughout 2026? I mean, are we going to look at 10 to 15% again next year?
Yes, we think so. So we're expecting about 14% earnings growth in 2026 and a similar level again in 2027. And that's really underpinned by the level of economic expansion, GDP growth here in the US, plus some of the tailwinds that we're seeing, particularly related to the tax bill. But let's not forget, we talk a lot about public markets, but some of the areas that we're most excited about when it comes to AI adjacent opportunities, they're actually in the private sector. And so a lot of discussion around tech, but you should really think about the energy needs and the opportunities that there will be in order to fulfill that. Because looking at the needs for data centers, the projections are that with the data centers already built, running at full capacity, they will take about 5% of the current electricity output from the US. If you look at what's on stream to be added...
What's in boxes and warehouses?
It is another significant component that gets you up to, say, 8 to 10% of the electricity output.
In doing that via equity or debt? Because there have certainly been nerves around the just vast amount of funding that's going on by private market players into the AI stories.
So a lot of what we think looks pretty interesting is in the private equity, the private infrastructure space. And again, not thinking about the how, right? Because there are many ways that you can play that energy theme, but certainly the demand is there. And right now, what we're seeing in terms of the level of demand is double what's actually planned in the footprint. And that's where regulations come into play too. It's not easy to get permits for those types of operations here, but it's an awful lot easier to do that here than it is in Europe.
All right, Sinead, thank you so much for joining. Great to see you this morning. That's BNY Wealth Chief Investment Officer Sinead Colton Grant. A quick check on your equity market, because we are just barely hanging on to gains for the S&P 500. The breath is certainly to the downside. You also see that in sectors in just a moment. To the upside, you have NVIDIA, just its sheer size. Broadcom now working with Microsoft to develop a custom chip for them. That's according to a report. So those shares are rallying. To the downside, Tesla, the biggest laggard. That's after a Morgan Stanley downgrade to equal weight from overweight. The analyst who's newly covering Tesla there says that all the non-auto stuff is already priced in. Alphabet follows in the flip and flop between Alphabet and NVIDIA. Berkshire Hathaway, that's one of the big losers. Todd Combs, one of the senior deputies there, moving over to JPMorgan. Let's look at the sectors, because I think this is really telling the fact that we are green, or actually we're basically unchanged, because this is what's going on. Only information technology is moving us higher, because Netflix is higher. Not Netflix. Netflix is lower. NVIDIA is higher. Broadcom is higher. Everything else, Matt, led by Staples at the bottom, is in the red.
All right. Very interesting trade. It doesn't look like we're headed for a new record, at least in this hour. Coming up in the next hour, OpenAI is going from a stock market savior to a burden as Wall Street sentiment shifts. We'll give you more on the AI race. I believe Mandeep is coming on set. At least I saw him walk by. He runs our tech coverage for BI. So this is Bloomberg Open Interest.
Some of the top calls this morning, what analysts are doing. First up, Benchmark cutting its rating on Marvell. The firm says that Marvell is at risk of losing major Amazon chip work to a competitor, meaning future growth could slow even as current orders remain solid. Those shares down a hefty 7.7%. Morgan Stanley, their new autos analyst, is resetting the firm's EV outlook. He's upgrading General Motors, arguing slowing EV adoptions will lift demand for traditional models. Meanwhile, he cut Tesla, Rivian, Lucid, all of them on weaker EV demand and the loss of federal credits for Tesla specifically. He also said all the non-auto news is already priced in. Finally, Barclays is turning bearish on Lennar, warning that weakening housing starts, muted prices, and strained affordability leave little room for a rebound. The firm says that their limited flexibility and stretched valuations heighten downside risk. Matt, those shares down 2.2% this morning.
All right, so a lot of action on Wall Street this morning. AI sentiment is shifting on the street as Google's Gemini soars in popularity. OpenAI's ChatGPT is facing questions about its lack of profitability and massive spending commitments. Joining us with a read on the AI race is Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. And Mandeep, you know, I woke up to this chart. I mean, we were showing it at the end of last week, too, but it's just like all the assets around OpenAI have been wilting, whereas those around Google Gemini have been soaring. How does this fight look to you?
I mean, look, a lot of these companies are trying to figure out how to deploy AI agents right now. That, to me, is the big part of what the market is focused on in terms of the addressable opportunity. Yes, Gemini 3 has caught up, but it all comes down to the approach that OpenAI is taking to deploy AI agents versus Gemini 3. And I don't think we have a decisive moment where we can say for sure that Gemini 3 would be most successful. I mean, there's a lot at stake on the NVIDIA side, you know, to make sure OpenAI is successful, given Google has their own TPUs. So from that perspective, with AI, everything always comes down to data and how you create an ecosystem. And, you know, I think we're still too early in terms of figuring that part out.
Couldn't you say it also comes down just to these corporate models, though, and who has cash to burn? Because Alphabet has it more than OpenAI. If they have a free version that's better than the paid version of ChatGPT 5, why can't they just continue that, basically bleed out OpenAI and then reign supreme and then raise prices?
Agreed. I think that's a great point. And in this race, everyone is finding it's very iterative. You know, just deploying an AI model, it won't work right away. You really have to grind through it to make it work. And then you will see productivity benefits. Like with Coding Agent, that market has exploded. But then out of all the $500 billion in CapEx that went into AI this year, we have just one use case, Coding Agent, which is really big, but we need 10 of those to justify $500 billion. Coding Agent, to me, is a $50 billion addressable market. So from that perspective, you know, Google has the most cash to keep burning, as you said, you know, and the competitors, if they don't find a new use case, they may have to throw in the towel. And OpenAI really talking about $1.4 trillion in spend, 26 gigawatt over the next 5 years, didn't help their cause because they obviously don't have the balance sheet and they are making these big commitments without showing investors we've got 8 or 10 new use cases that are emerging, which will be big markets. And that's where I think they're missing. There's a big aspect that's missing in OpenAI's story is they don't know what those use cases are going to be. AI agent is too general.
Or where they're going to get the money, right? I mean, if you ask.
I mean, so far they have been quite successful in raising that money.
So far they have done very well. If you want the shares, I know somebody who's willing to get rid of them. CoreWeave shares getting hit today on a new convertible note deal. It's only a $2 billion deal, which I think, you know, in this world of multi-trillions shouldn't really hit the shares this hard. What's going on with the CoreWeave story?
Yeah, well, with CoreWeave, I think being a neo cloud provider right now, it's even harder because, one, you're betting that this infrastructure boom is going to last at least, you know, next 3 to 5 years, and we will be supply constrained. I mean, it comes back to why NVIDIA has been so successful in you know, keeping up their margins because they're supply constrained. It's the same thing on the neo cloud provider side. They're the ones who are getting the GPUs from NVIDIA, and they can offer it to enterprise customers. And anytime the supply-demand imbalance is solved for, that's when the neo clouds will be the first ones to suffer. Because the moat is not as strong as, you know, the hyperscalers who have got the data and applications. And market is still trying to figure out, you know, what are the big use cases and whether this AI boom will continue without an air pocket. So I think there will always be concerns around the neo cloud providers because they don't have that sort of business model to sustain for the next, you know, 5-10 years if the supply-demand imbalance is solved.
It's a big if, right?
Yeah.
Because from Sinead, Colton, Grant's perspective, demand is still twice as much as what
which is great for neoclouds. I think you don't have to be worried as long as demand continues to outstrip supply. The moment it's more in balance, that's when the neoclouds and the other chip makers, I think, are going to struggle.
Mandeep, this has been so fantastic. Thank you for joining us. Mandeep Singh of Bloomberg Intelligence. Coming up, Paramount gets hostile in the Warner Brothers bidding war. Our litigation expert from Bloomberg Intelligence is going to be joining next, a conversation you don't want to miss. Paramount has taken its Warner Brothers bid public with an offer of $30 a share in cash after Netflix bid $27.75, and Trump voicing concerns about that deal. For more on potential antitrust concerns, we're joined now by Jennifer Rees. She's a senior antitrust litigation analyst for Bloomberg Intelligence. Jen, a couple of things, a lot of things happening.
Yeah, a lot.
For one, Trump saying the big merger between them could be a problem. And Paramount, with their bid this morning, one of the things they explicitly said, one, we're offering more money. Two, we'd have an easier time when it comes to getting through antitrust hurdles. Would they have an easier time?
Absolutely. There's no doubt in my mind, not just from an antitrust perspective, but from a political perspective as well. We've seen in the news that the president is much more behind this Paramount bid than the Netflix bid. But from an antitrust perspective, it's straight mathematics. When the Department of Justice looks at these deals, they look at these horizontal overlaps. We have streaming, we have production of original scripted content, and we have some vertical issues as well. They look at them and they sum the squares of the market shares. And if those numbers exceed a certain threshold, the deal's presumed unlawful. So just walking in, if you do that and you look at all the streaming options with Netflix, this is a deal that's presumed unlawful. You don't have that case with Paramount. So I think just from an antitrust perspective,
as the market stands now, right? Because you're looking at the market in a very narrow, through a very narrow lens. You're saying like Netflix, Prime, Hulu, Disney. But if you do what Ted Sarandos wants and say YouTube, by the way, I often click YouTube instead of those others, right? Or even TikTok. I never click TikTok ever, but a lot of people do, right?
A lot of people do.
If you look at it through that broader lens, then their market share is nothing.
That's the classic antitrust defense. This is what is always argued because market definition, which is what you're talking about, is usually dispositive. The way the Department of Justice will look at this, and by the way, they almost always tend to look at these markets narrowly, is from a consumer demand perspective. What will consumers substitute if they don't like the price or the quality of some service that they're using? Now, you may switch to YouTube, and I think a lot of the younger generations might switch to YouTube, but I think there's a segment of you're in the younger generation, Matt.
One of the kids.
Thank you.
But I think there's a pretty large segment of the population that would not look at YouTube as a substitute for Netflix, especially if you're looking for an old movie or you want to, stream a series, an old series or something like that. And as long as there's some segment that would be harmed because of the market share created by that combination, wouldn't be willing to switch to YouTube, the Department of Justice is likely to look at that market more narrowly.
Are you maybe looking at the Department of Justice through the wrong lens? Because that's what they would do if they were technocratic and operating on precedent.
True.
But what if the president said, don't do it that way?
Well, I will say that Gail Slater, who's the Assistant Attorney General in charge of antitrust there, is really enforcement-minded. I think she is a straightforward, good antitrust lawyer. I think she wants to do things the right way. But you are right. She has been her decisions have been influenced by what the administration wants, and I think that would probably happen again. I don't know how the Department of Justice, honestly, with a straight face, clears the Netflix deal unless, and this is pretty radical, they were to divest HBO Max.
Yeah, but Trump doesn't want the Netflix deal, so maybe
I don't think so.
They can work in concert together and achieve the same goal.
How did this Department of Justice sue to block Time Warner AT&T?
Right, that was Trump. That was Trump 1.0, his first administration. He did not like CNN, so he wanted CNN to be the same asset. How odd, right? I think the third or fourth or fifth time it's been sold. He did not. He wanted to punish CNN. So there was, under Obama, there was a settlement. But what happened is when Trump came in, he said, no way, you've got to divest CNN. They wouldn't do it. But they won in court.
They won in court and on appeal as well. Jen, thanks so much for joining us. Jennifer Rhee covers legal stuff for us at Bloomberg Intelligence. Coming up in the next hour, Sitara Sundar joins us to react to private market FOMO over AI investments. We've been talking about that this hour. Stick with us for more. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. After 4 straight days of gains, equities struggling to hold on to a bid this morning.
Coming up, it's getting hostile as Paramount crashes the party, taking its bid for Warner Brothers public with a $30 a share all-cash offer, topping the offer from Netflix. Michael Wolff of Activate breaks it all down for us later this hour.
And major moves at JPMorgan. Jamie Dimon brings in Buffett insider Todd Combs to lead a $10 billion investment drive focused on U.S. economic security.
That's a big story we'll cover this hour. Plus, President Trump set to unleash $12 billion to ease farm fury as tariffs and low crop prices batter growers. So we'll talk about the effect that could have on farmers and the companies that they consult with.
Yeah, Deere, maybe some equipment buying. From farmers to AI, we're going to begin with a warning from Thoma Bravo founder Orlando Bravo, who I spoke with on Friday, who said that the rapid advancement of AI is stirring up enormous anxiety among investors, that the hype has triggered a fear of missing out among VCs specifically. He was worried about a bubble starting to form in that segment of the market. I spoke with him at Bloomberg New Voices in Miami.
Right now, there's a big difference between the private markets and the public markets. Public market investors are great, and they're trading these businesses on PE multiples. And if you're not making money, they're punishing your stock prices. And that happened again after 2021. We had that public market bubble in that time period. But the venture capital community in the private market, you see one round after another for very young companies, 5 billion valuation, 10 billion, 20 billion. And look, even if these companies have the right product market fit, the right technology, the right idea, the right customer base, think about what it takes to just double your money if you pay for $20 billion for a company. They have to produce about $2 billion of free cash flow in short order for a fundamental investor to say, hey, this is worth about a 2x, assuming no other rounds of financing, assuming no other dilution, including an IPO. That requires just incredible leadership. There are very few leaders in the world that can do that and that can create those kind of companies and that kind of value. So I think people are just right now in the private markets, they have this FOMO over AI that they need to get in, that they need to be part of it. And that's going to cause a lot of young people to make a lot of mistakes, just like I did in 1997, 98, and 99.
Does it look like the late 90s? Is that the inevitable path that this goes down, especially for VC, sort of a bubble that's forming that inevitably gets popped?
In the private market, in the venture world, that is so obvious to us. I mean, this is a very young technology. People that want to sell to corporations, we say technology in the corporate world is not revolutionary, it's evolutionary. It takes a lot of time, no matter how fast technology moves, for companies to absorb them into their processes, to change the way they work, to find budget, to use it correctly. Many, many years. Even software systems right now that do a 5-to-1 ROI, that is so obvious, that has been proven many times, the sales cycle on that is 2 to 3 years for a customer to really implement it. So these things in the corporate world where the real big money is, it takes a lot of time. So you have to just match that up with the realities of your customers and of business and fundamental values. Now, this time, of course, we're dealing with something really big that will be over time incredibly transformative, where the existing companies have to not only hit their numbers now, but have to really invest in that future and position themselves right.
Thoma Bravo founder Orlando Bravo speaking with me at Bloomberg New Voices in Miami. Let's continue the conversation. Joining us now is Sitara Sundar, JPMorgan Private Bank Head of Alternative Investment Strategy. Sitara, great to see you.
Great to see you.
I actually wanted to talk to you about this because you obviously look at both alternative and public markets. And the argument that Orlando was making is that public markets are actually doing a better job discerning AI winners and losers. They're actually reacting to different developments. But specifically, he's calling out VC because he's in private equity and, you know, maybe suits him. But saying VC has a problem, that there's FOMO, that there's chasing, and that's where the valuation problems are. How do you see it as the divide between the two?
Yeah, look, I think that the simplest way to look at it is how these kind of tech innovation cycles tend to progress, and then where you get exposure to that in public markets versus where you get exposure to that in private markets, and then assess valuations from there. Usually what we've seen in tech innovation cycles, whether it's what we saw in the internet cycle, cloud, and what we're seeing right now, is you have the infrastructure layers that are built first, whether that's physical infrastructure or digital infrastructure. In this case, it's like the power players, utilities, as well as semiconductor players. And then you have the platform technology and the application layer that's built after. Over the past 3 years, what we've seen is that the value has accrued to the infrastructure players. And that's primarily a public market play. Outside of power infrastructure we can talk about, but you've seen value accrue to the hyperscalers, to the semiconductors, and to the utility players, and on the power side it's a bit of a mix between public and privates. What I think I agree with is that when you think about the platform tech, like the foundational models and then the application layer, we're still in the early stages, and we are starting to see a little bit of concentration in where the valuations and funding is going to the VC space. It's only in a handful of players, but the biggest point to us is whether or not adoption is going to accelerate to justify those valuations. And what we think about moving forward is that adoption is going to continue to accelerate outside of just the tech companies, which is where a lot of value has accrued. We're already starting to see signs of AI actually impacting the bottom line of companies, which I think is a point that people miss. There are like early reports out there that are showing that revenue growth and margin expansion and even like patent creation of these like AI forward companies are actually far outpacing those that are not integrating AI into their ecosystem. So the biggest tagline for us is that we're 3 years into this cycle. There's going to be pockets of froth that are going to build. Part of that is happening in the VC space. I would argue some of that is happening in the public players too, especially on the software side. But there's still a meaningful opportunity set as we see adoption grow, as we start to see that impact to the bottom line.
Are you starting to see some froth in the private markets support of the infrastructure play? Because, you know, we see such huge exposure to data centers in private credit.
Yeah, I think that there's two different things. One, on the where we're seeing pockets of froth within the private market space. I would say one on the VC side, on two on the infrastructure side. There's a little bit that's coming within the data centers from a real estate perspective, but we're not seeing as much actually on the power side. I think a lot of folks assume, given the amount of investment that's come to the power infrastructure side, that there's valuations that have been bid up. But what we're actually seeing is that there's likely still going to be a multi-year investment opportunity within the power infrastructure players specifically, because even if you just look at the United States, by 2029, the U.S. could actually reach a power shortfall, given the amount of AI-related demand that has pushed the need for a certain power capacity even higher. So we're seeing pockets of valuation, elevated valuations within the data center side, but we're not seeing it on the power side because we believe the earnings is going to justify that.
So one question that Matt likes to ask that I think is so important in this moment is where you put the incremental dollar to work in AI right now. Does it make sense to do what you're describing, more private, more power infrastructure, or can you still buy NVIDIA and Broadcom and some of the public names? What makes more sense for an investor who's trying to get more exposure to AI generally?
Yeah, I think that there's a barbell approach, if I can, which feels like a cop-out, but let me explain. I know, there's chuckling. I think that there's the infrastructure side. We're 3 years into it, but there's still going to be room to go. I think that you would be remiss and it's dangerous to not invest within the hyperscalers because there's still going to be meaningful earnings growth and opportunity there. Same thing on the power side. I would say, though, that the private markets, which I know sounds self-serving, but the private markets are likely going to be the dominant players within the application layer. So when I think about where to put that incremental dollar moving forward, you should continue to maintain exposure to the infrastructure side, but that application layer is where I would start. We're starting to get a little bit more excited because we're actually starting to see impact.
Ed Harrison writes Bloomberg's Macro View column, and today he said he thinks that U.S. rates are going to get pulled higher with global rates. In fact, after reading his column, I looked back at the last year, and the Fed has cut rates by 75 basis points, and yet the 10-year is exactly where it was last year. As inflation, heads higher. I made a chart. showing all this stuff here.
Amazing.
And Joe helped me. Are you worried? You know, the white line here is inflation. If that continues to go up, it's going to be much harder for the red line, which is Fed funds, to continue to go down. And the blue line, which is the 10-year, could well float higher.
Yeah, look, I think outside of talking about artificial intelligence, this like new macro regime that we're in is probably the second biggest point of conversation and debate within our client conversations as well. We do expect that inflation is going to stay above the Fed's target over the next, not even just year, but in perpetuity. We expect that even if rates come down, that will likely still be in an environment where rates are going to be higher now than they were in the post-GFC to pre-2022 timeframe. So the biggest takeaway for us is that portfolio construction is going to need to evolve in lockstep. And the biggest tagline there is that the 40 part of your portfolio and the longer duration bond part of your portfolio is really good at protecting against economic growth scares, but not as good at protecting against inflation-oriented scares. So we're leaning a lot more into alternative sources of income, whether that's in pockets of direct lending or really real assets like real estate and infrastructure too. That the idea of the building blocks of a portfolio evolving in lockstep to a macro regime that is shifting.
What about the animal spirits have been reawakened with an M&A boom? All the financing that's coming to market, how pinned is that to having inflation be at least under control and getting some size of rate cuts?
Yeah, I think there's like a certain element of a boost in M&A activity being correlated to easing financial conditions. We've seen that historically. But I think even outside of that, we would still expect to see M&A activity and capital market activity pick up because a lot of the secular innovation that's taking place within this ecosystem, whether it's artificial intelligence, but even looking beyond just AI, we're starting to see a boom in healthcare M&A finally after so many years of kind of waiting. When we think about the next 5 years, the amount of patent cliffs that are going to take place by 2030, it's not just easing financial conditions and rate play, it's also a secular innovation play as well.
Very cool to have you in here, Sitara. Thank you so much for joining us. Great intel. Sitara Sundar there of JPMorgan. Let's get a check of what's going on in markets right now. We started higher, and the S&P has now drifted a little bit lower, just 1/10%. We're still at 68.61, so less than 30 points away from closing high.
But very far away from Stolfis's 8,100 target.
Well, that's for the end of 2026.
No, but that's still so punchy. Yeah. So punchy. Anyway, some single stock movers that we're looking at this hour. It's the drama, right, that continues between Paramount, Warner Brothers, Discovery, Netflix. Paramount, Skydance, they've taken their bid public. $30 a share in cash is what they're bidding, just days after the company agreed to a deal with Netflix. By the way, we're going to get more on this bidding war later this hour. We'll speak with Michael Wolf, Activate co-founder and CEO.
And IBM is buying data streaming platform Confluent for about $9.3 billion in one of its largest takeovers ever. IBM offered, I think, $31 a share. And Confluent is headed, I think it was headed there.
Yeah,
I didn't see it.
It was a little bit below that, but yeah, headed in that direction. Some more AI news. Google next, they're reaching a deal to develop data centers paired with electric plants in 3 undisclosed locations. But market sending both those shares lower this morning, Matt.
Coming up, another major departure at Berkshire Hathaway, and I think it's more, well, maybe equally important where he's going. We'll tell you Todd Combs' destination next. This is Bloomberg. Let's get to high interest now. Look at what's making headlines around the world. White House economist Kevin Hassett says it'd be irresponsible for the Fed to map out interest rate moves months ahead, insisting decisions must follow the data. A leading contender to replace Jerome Powell next year, Hassett praised Powell's consensus building and expects a cautious rate cut on Wednesday. He also says AI-driven productivity could give the economy room for lower long-term yields. Lando Norris clinched his first F1 World Championship with a controlled third-place finish in Abu Dhabi. McLaren's strategy kept him safely ahead of Charles Leclerc, avoiding a scenario that would have handed Max Verstappen the title. Norris, now a 7-time race winner this season, topped Verstappen by 2 points, completing a remarkable rise after years without a victory.
Nice to see it.
Verstappen had it pretty good come back this season, too. JPMorgan has hired Berkshire Hathaway veteran Todd Combs to advise the CEO, Jamie Dimon, and lead a new $10 billion strategic investment effort aimed at strengthening U.S. economic security. Combs, a longtime Buffett lieutenant and Geico CEO, will join next year, leaving Berkshire as it prepares for its own leadership transition.
More on Todd Combs. We're joined now by Bloomberg managing editor Tom Metcalf. Tom, two sides to this. There's the Berkshire side and the JPMorgan side. Starting with JPMorgan, this hire for this, what is it, a security and resiliency initiative, what exactly are they throwing Todd Combs behind?
Yeah, it's really interesting from both sides. On the JPMorgan side, they basically picked him to effectively lead this 10 billion sort of direct equity investments that the bank is planning to do into stuff for areas like security, defense, critical minerals. And this is all part of that $1.5 trillion financing commitment that they've said, they're going to basically roll out over the coming years. There's about 50% more than they expected given the change in geopolitics. But it's a really intriguing hire. He's one of the sort of most influential people, I'd say, behind the scenes in finance, works with Buffett, obviously, basically ran the equity investments along with Buffett and another executive at Berkshire. And as well as that sort of specific role, he's going to be a senior advisor to Jamie Dimon and just generally, I guess, add to that sort of very strong bench of expertise at JPMorgan.
Just to get to the Berkshire exodus for a moment, it does look like that's happening, doesn't it, Tom? I mean, we've had a lot more personnel changes than we normally do for Berkshire Hathaway.
Yeah, complete change. Obviously, you've got Buffett heading out the door at the end of the year, and that seems to be precipitating basically a changing of the guard, I suppose. So, as well as Todd, they're changing out their CFO. And, I think it's going to be really interesting. Like, that's, probably one of the momentous change any company will have to go through. And obviously under Greg Abel, they're looking to kind of maybe just start with a fresh set of characters.
Yeah, it does just raise questions, I guess, in general of what Berkshire actually looks like post Warren Buffett if a lot of his deputies are leaving. Tom, on this idea of JPMorgan, their plan, $1.5 trillion, pour that into sectors that are crucial for the security and national economy of the United States. How much of this is also a JPMorgan reading where the winds are going, reading a White House that has really tried to do the same and is looking to the private markets and private players to help fund some of it?
Oh yeah, absolutely. In part, I'm sure it's done with one eye towards the White House. Is probably exactly what the Trump administration would like to see. Basically, before this recent announcement, it was going to be $750 billion, or that's what it expected. So a significant uplift. But of course, it also just reflects the reality, right? Moving into a more turbulent, more geopolitical world. And this is the kind of thing, you've seen it in defense sector shares, particularly in Europe, where, this kind of commitment is probably going to be, gobbled up by the market. And as part of today's announcement, JPMorgan also said there's going to be this advisory board that's going to be helping out Todd Combs. And, you've got literally a who's who of finance, politics in that business. You've got Jeff Bezos in there. You've got former Secretary of Defense Robert Gates. Basically, whoever's a big name in business seems to have been tapped for this thing, which just goes to show just generally how much Wall Street and the wider business world is lining up behind initiatives such as this.
So it's kind of exciting for JPMorgan, for Jamie and for Todd. When do we expect to start seeing action out of this group?
So Todd should join in January, according to the statement, and then obviously, it's how quickly do they want to deploy that particular, 10 billion. I mean, that's literally JPMorgan's capital. So I'd be curious to see, if it's, the sort of momentum, the kind of sort of metabolism of that is extremely quick, or if it's going to be quite steady, and particularly maybe we won't see any real world impact for a while. But if they're looking to get, in terms of the financing, 1.5 trillion. Out the door, you're going to expect to see that, starting, if not now, very, very soon.
Yeah, it turns the $10 billion slightly bigger. Tom, thanks so much for joining us. Bloomberg's Tom Metcalf covers finance for us out of London. Still ahead, Paramount making a hostile bid for Warner Brothers. We'll discuss that with Michael Wolff. He's the co-founder and CEO of Activate, used to run MTV. This is Bloomberg Open Interest. Let's get a check on the stock market right now. We kicked off the trading session slightly higher. As you can see, have fallen steadily. Now down 11 points, but the breadth has gotten better. More than 200 stocks are up and fewer than 300 are down right now.
In terms of some of the individual movers, you can see there Broadcom is one of the big gainers. It's done a deal with Microsoft, reportedly, that they're going to supply them with some custom chips. If you go over to the downside, because maybe that one's more interesting, you know, Tesla over at Morgan Stanley has a new analyst coming in and has changed it from overweight to equal weight, saying that all the non-auto news is already priced in, and therefore Tesla can't really rally much higher than that, Matt.
You know what I'm going to do? I'm going to walk over to the screen here because we can pull up the industry groups, and something has changed. We've got another one gaining. So when Dani last showed you this screen, the GRR on the SPX L1 index, only IT was rising. Now we have industrials gaining as well. So the breadth is getting better. We have at least one more industry group doing a little bit better. So maybe a little bit of a turnaround in store for the close today. Remember, we were at 68.70, so just 20 points away from an all-time high. And now we're fewer than 30 points away with the drop that we've seen.
Yeah, it's been this slow melt up in the equity index over the past couple of days. We've been up for 4 straight sessions. This would end that if we are down 0.2%. But again, it's the individual movers that are more interesting, and we're going to talk about Paramount in a little bit. I think it's very notable that Paramount is rallying in today's session after they've made a bid for Warner Brothers Discovery. Netflix has fallen every time that they get closer to buying.
Yeah, I think it's fascinating as well. And Paramount, in its bid today, $30 a share in cash, also has a $5 billion breakup fee. But when I saw last week that Netflix had a $5.8 billion breakup fee, I thought, man, I would take that offer and then break it up and then go with another offer, because then free money.
Yeah, but President Trump might not allow them to go through with that offer. We're going to speak about this coming up. It's the $72 billion takeover deal from Netflix gets challenged. We're going to speak with Michael Wolff of Activate coming up after this break.
Paramount making a hostile bid for Warner Brothers just days after the company has already agreed to a deal with Netflix. Michael Wolff, Activate co-founder and CEO, says the proposed Netflix-Warner Brothers deal would be a huge win for Netflix, writing, quote, "The average person is subscribing to as many as 5 streaming services. Since Netflix is already the default service, adding HBO not only increases the programming on its own service, but gives it another to sell." He joins us now, I'm pleased to say, here on set, flown in from the West Coast. Michael, great having you here. I think in your point, I see another point, which is that most people who subscribe to Netflix already subscribe to HBO. So
not necessarily.
I think Ted Sarandos has said 75% of their subscribers.
That's not true. Our research shows it's roughly 30%.
I see. So it wouldn't exactly blow their market share up, or it would blow their market share up substantially.
Well, I mean, when we look at this from the perspective, it's how you look at market share. And so if we look at streaming is about 46% of television viewing. And you start looking at the numbers, you've got 12%, roughly 12% is YouTube. You've got roughly 9% is Netflix. 4% is Disney. And then you go all the way down. HBO Max is less than 2%. So if you look at this, yes, it's additive, but at the same time, the bigger competitors are going to be Amazon and Tubi TV, and people aren't talking about them. And then when you look at the number of titles each of these services have, it's also a huge difference. I mean, Netflix has roughly 7,000. Disney has roughly 4,000. You've got 3,000 with 3,000 to 4,000 for Paramount, but you've got Amazon has 25,000 and Tubi has 70,000. So on all these different sides, it's not clear that this is going to be a massive share of the business.
It's interesting because when it comes to Warner Brothers, it's been framed as a must-do deal for them, or they need to figure something out. You frame it for Netflix that this is a must-do deal for Netflix. And I think that's interesting because many people would say it's healthy on its own. It is starting to come up with these various titles that are popular. Why does Netflix need this deal?
There are going to be a couple things that are going to drive success in streaming. One of them is really establish IP, and then global franchises, and they have to be global. They can go everywhere. With Warner Brothers, they get Harry Potter, they get Lord of the Rings, they get all the DC comics, which I could argue are way underexploited. They get a whole set of shows, and even though if you look at what Netflix has been able to do with Bridgerton and Stranger Things, it's nowhere close. The second thing, by the way, what is missing here is live sports, and that's a case where Paramount has an enormous amount of live sports. Amazon has been going deep on live sports. Peacock probably has more sports than anybody. So I guess my point is that this game is not totally clear. And then YouTube is basically eating the internet. And YouTube for a lot of people is TV.
Right, because Netflix has been trying to argue that it won't have an outsized market share because you need to count YouTube and TikTok.
Because you should count it, but some people say that's not a streamer, right? Others say I choose that over streaming services quite a lot. I think the part that's most difficult to talk about is the role that President Trump plays in this. Netflix is seen as this sort of globalist bastion of liberalism, right? The programs you mentioned, I think, can confirm that. And then Paramount is run by David Ellison, owned by the Ellison family, which has very close ties to President Trump. Listen to what David Ellison told Lucas Shaw at our Screen Time event earlier this year.
We have a good relationship with the administration. And look, I think if you look to that, I do believe other things that have been rumored about, right, are very large-scale players that could potentially create monopolies, obviously, in the ecosystem. And again, I think when you look at the lens of consolidation, for us, I'll keep going back to it, it's always how do you create long-term value creation? How do you put yourself in the position to produce more content, not less? And how do you ultimately build something that is better for the consumer?
So you could read Netflix into that when he talks about monopolistic position. And I wonder how important the CNN aspect of this is, right? Because President Trump would surely love to have allies running CNN.
Well, I think that there are a couple other factors. One of them is the reception of the creative community, which is much more interested in a Paramount deal. The second is the
Why is that, Michael? Why is the creative community much more interested in a Paramount deal?
Because they look at Paramount as an established studio. Paramount has already said that they're going to increase the number of theatrical releases from what they have today to 30 by doing this. And they appear to be committed. They truly are today a movie studio as well as a TV studio. And they're clearly committed to the theatrical business. So there may be an outsized influence, not just to the president, but also the creative community, as well as other businesses like the movie theater owners. It's hard to guess.
It's a win-win-win.
Well, it's a win on their side. It's hard to guess what will happen and how much this. A lot of this is going to come down to not just Trump, but it's also going to come down to the shareholders. Paramount has a month to put this out for a shareholder bid. Winning those kind of bids is hard.
I was going to say, and I've been talking to Matt about this, when that Paramount hostile bid came out, you can see it there on the screen, shares go up 5%. Every time Netflix has talked about this deal, shares have fallen. Why do Netflix shareholders not like this deal? And to your point, if they need something like this, if they need the IP, if they need the movie studios, the different things that they have, why wouldn't Netflix be seen as more favorable in terms in the eyes of the shareholders to buy Warner Brothers Discovery?
Well, first of all, investors believe that Netflix doesn't need this. And it's a huge cash outlay and money that Netflix doesn't necessarily have, and they're not expecting that. And then, second of all, they're wondering whether or not it makes sense for Netflix. Not just do they need it, but whether or not it's really going to be additive.
By the way, Michael, I find it kind of a bummer, the whole IP thing of it all, that the entire slate, it's like Toy Story 5, another Super Mario movie, another Scream movie, and that Netflix wants part of that. It feels like creativity is all being sapped, and it's just part twos of Toy Story for the rest of eternity.
Yeah, but I mean that's been going on for the longest time. I mean Disney, which has had for the longest time the largest market share in.
But does this make it worse? If all of a sudden Netflix can lean on that too?
I don't think it makes it worse. I think this is just consistent. I mean, when you look at this is where this game is going to be played, and nobody's going to invest hundreds of millions of dollars in an unproven franchise.
I hear what you're saying, right? Like these things just become made by AI and all about marketing, and there's no creative force. And I think, Michael, what you're saying is Paramount does want to bring that creative force. At least that's what I took from David Ellison. I thought that was a fantastic interview by Lucas Shaw. I listened to the whole thing. David Ellison seems genuinely interested in really making something special in terms of entertainment, not putting out Toy Story 7, you know?
That may be the case, but when you look at the biggest hits, we're talking about Top Gun. We're talking about things that are established franchises. And also, by the way, it's also the biggest stars. And so, once again, it's a huge risk in the film business. Of course, somebody who's much more creatively driven is going to be willing to take that risk on new IP, especially if it comes with established stars.
Yeah, I mean, Tom Cruise, the man could use a rest. He looked amazing in Top Gun, but
Top Gun 1.
And 2, he looked great, no?
I mean, yeah, he looked great.
Well, we should expect more Mission Impossibles and more Top Guns.
Poor Tom Cruise. All right, Michael, this has been
and more Star Treks.
I guess those are all good things. You know, the world could use that.
Yeah,
exactly. Michael, this has been so fantastic. Thank you for joining us.
Good
Michael Wolf of Activate. Coming up on the show, we're going to be speaking with Christina Minnis, Goldman Sachs head of global acquisition finance, as companies rush to the bond market for cheap M&A funding, a conversation you don't want to miss after this break. Companies are rushing to the bond market for cheap M&A funding, making this quarter the biggest in 4 years for acquisition financing at $113 billion globally. That's according to data compiled by Bloomberg. Joining us now, I'm pleased to say, is Christina Minnis, Goldman Sachs Global Head of Credit and Asset Finance and Head of Global Acquisition Finance. Probably the busiest woman on Wall Street. Christina, wonderful to see you.
Thanks for having me.
I mean, it has been this huge revival. How much of it, though, is just down to fundamentals are really good, people like these deals, and things get funded very easily, versus just a lot of cash that's being put to work and the sheer demand that helps keep spreads tight?
I think we're in a position of everything seems to be working. Number one, there is a lot of liquidity in the markets. Number two, outlook on the economy looks very positive for 2026. We've revised our own GDP U.S. growth estimates to 2.5%. Credit spreads have come into a place that are very attractive. I think boardrooms have a little bit more confidence, and there's just a tremendous amount of pent-up demand for product. And then you also have the sponsor dynamic, which is extraordinary. M&A, as you know, is up meaningfully year over year, but sponsor M&A is up almost 45%. And the mega deals have returned. Mega deals, we define that $10 billion or more, are up almost 100%. So if you think about that dynamic, what that means is if those transactions are working, the credit markets have got to be able to support them. And we haven't even talked about what's going on with AI, infrastructure, energy transition. You know, investors are very, very interested in financing that. And if you take a look at the percent of the market that is supporting AI and infra right now, it's about 1 or 2%. It should be closer to 5%. And go back, look at other big technology moves around TMT and the internet. Even energy back in the day, that percent was almost 15, 20% of the markets. So we have a long way to go for investors to get appropriately indexed to these, underlying trends.
So, but is this a new M&A cycle, or is this kind of a one-off AI thing with some media deals thrown in, or?
So here's my view. M&A was pretty quiet for the last couple of years, and 25 started off with a big surge, and then it got a little quiet based on what happened in April. And people were focused on a part of the market that's down. The sub $500 million M&A market has been down this year about 9%. So it's come back, but we're only at 5-year averages. So we're getting back to hopefully a very strong M&A environment. So there's the fundamentals of the M&A market coming back. I think it's it's definitely spurred on by companies looking at AI, not just the data centers, not just energy, but every corporation in America, including Goldman Sachs. We've just launched what we call 1GS 3.0, and that is our version of looking at AI transforming our business, not just for our shareholders and efficiencies, but how does it change the client experience? So you combine a strong M&A market, sponsors that have a tremendous amount of capital, an AI backdrop, investors that want to invest, and I think you're going to have a very strong 26.
Is there an element, though, that you need to hedge or at least find a little safety in being overly exposed to AI? And I kind of asked this with the knowledge of last week. Our reporting suggests that Morgan Stanley was going to be selling some of their exposure via SRTs. Is that something that needs to be happening in this environment, just given, yes, M&A more broadly is doing really well, but there is a bit of outsized exposure of AI, at least starting to build?
So if you go back to sort of fundamental credit, you always want to be hedging when you have tall trees. And so anytime you've got exposures to individual companies or industries, of course it's prudent to hedge. Everyone does it, and the ones that do it the best are the ones that can handle the volatility. So I don't think the fact that one institution may be hedging a specific exposure is an indication of a problem. It's just prudent risk management.
What do you think about rate expectations? And I've been kind of harping on this today, but as the Fed has cut the last 75 basis points, the 10-year yield is still at 4.1%, 4.2%. And indications are that inflation is going to continue to head higher, and the 10-year yield could be pulled higher by global rates next year, too. Does it matter?
Look, our personal view on the 10 years, it's going to be around 4.25 now for the foreseeable future, which is a very comfortable place for that Treasury to sit. And those of us that grew up in the business in the 80s, it was a very comfortable level for the 10-year. I do think we're going to have a couple more rate cuts. I think everyone's expecting, even the market at 97% odds of it happening on Wednesday, 2 more for our perspective in 26. So I think the front end's going to come down, settle in the 3 to 3.25%, and the 10-year, our expectations, it's going to hover around 4.25, which is a very healthy place for cost of capital, deals getting done.
It's normal.
Normal. I think it's normal. But I'm older than you are, a lot older than you, the two of you.
Nonsense. Okay, look, when it comes to this market, though, again, spreads are really tight. Deals are getting done very easily. If you do look in little pockets, you can see some concerns, and it plays out a lot through public markets, be it Oracle CDS spreads starting to widen. They're going to have earnings on Wednesday. CoreWeave announces $2 billion of convertible loans, and their stock sells off. Do you also see some of that risk starting to creep into market of these big AI companies that maybe don't have the revenue to back up some of the debt load that they're starting to take on?
So here's what I would say. I think in any major technology transition where capital is flowing into an opportunity, you're going to have periods of volatility, and there's going to be many winners, and there'll be a few probably that are not going to survive. But that's very normal. I think there's real, credit dispersion as well still in the markets. And while almost everything's working, you can find examples of things that aren't working. And so investors are being careful to look at companies that are going through, significant issues. And so just like in AI, there'll be many, many winners, and I'm sure there'll be a couple of losers. But there's nothing that we see on that theme that we're overly concerned about. Just based on what we see investors looking for, the fundamentals, the huge growth that this investment should yield for not only the U.S., but the world.
I lived in Berlin for a long time, and the most exciting event of the whole year is Super Return. They have so much money, right? They know how to throw parties.
Very good parties.
Is private markets, like private capital and private equity and private credit, taking up more and more of the slack, or is that going to start to turn around? Are banks going to start fighting back?
I'm really glad you brought this up, Matt, because I love to talk about this. I think what's happened in the private markets is as important, as exciting as what's going on in some of these innovative technologies, because what's happening is driven by the U.S. We're innovating. We're creating deeper pools of capital. The private credit market right now is $1.7 trillion, and that is the below investment grade. We think the non-investment grade, the investment grade private credit market is also in the low $1 trillions. Those two markets are growing at probably 20% per year. Add to it what we call the liquid public markets, public bonds, IG, 8-9 trillion, leverage loans, high yield, 5 trillion. Those are very liquid pools of capital that are all there to support. And what's great about private credit and public at Goldman Sachs, we love both of them. We're a top player in both markets. And so we're very bullish on both of them. There'll be use cases for one or the other. We'll flip back and forth. Companies will sometimes go private, sometimes they'll go public, but they're going to find the best source of capital. And sometimes it'll be private, sometimes it'll be public.
People love to frame it, though, as competition, that the two are going head to head.
It's competitive, but that's America.
But could there not be circumstances where there's riskier lending standards or more lax lending standards in order to win that over?
Sure, absolutely. The way we approach it, fundamental credit analysis. You have good credit processes, you monitor your credits, you don't do every deal. It's the same fundamentals that have existed for decades. But the fact that these two markets exist and they, quote, compete, it drives down cost of capital for investors. It provides solutions for clients. We have a client that's in the behind the meter, or I like to reframe that as off the grid energy sources that needed $5 billion of capital. It was private equity backed. It was private credit backed. They came to us. We looked at a structured off-balance sheet IG solution. We looked at a high-yield solution. We looked at an asset-based lending solution. They chose 2 of the 3 and raised an incredible amount of capital, 100 basis points inside of what we might have thought we could have raised based on demand. That's a great use case for why both markets will compete, but not in a negative way. It's just going to add more opportunity for our clients.
This is why we love it when you join us, Christina. Thank you so much for coming in. And I hope you come back soon. Christina, Minnis of Goldman Sachs. Coming up, President Trump is set to unveil his long-awaited farm aid package. We'll bring you the details next. This is Bloomberg. President Trump is set to unveil a long-awaited farm aid package this afternoon. For more, we are joined by Bloomberg's Washington correspondent, Tyler Kendall. Tyler, what do we know about the size and who gets this money?
Yeah, hey, Matt. Well, this is long-awaited assistance for a key base of support for this White House. We are reporting that this will include one-time payments to crop farmers under the Department of Agriculture's newly established Farmer Bridge Assistance Program. A senior administration official tells me that those farmers who qualify are those with an average adjusted gross income of under $900,000 for the 2022 through 2024 tax year. So it's supposed to be going to these smaller farmers, and it's going to extend to typically the crops that we think of, like corn and soybean, but there's also going to be a provision in there that's going to go to those specialty farmers as well. Now, there's still a lot that we're waiting to glean details from, but it's our understanding that farmers are going to have from today to December 19th to submit what's known as their acreage reporting data, essentially how much they plant. That will then correlate with exactly how much money they get from the federal government. An official tells me that the government is planning to get money into the bank accounts of these farmers by February 28th, 2026 at the absolute latest. So they're hoping to have this so that they can plan for the next harvest season. Now, I mentioned soybean farmers, which of course have been squeezed particularly hard when it comes to tensions with China. Even as we've seen a gradual resumption of China importing U.S. soybeans after that meeting between President Trump and Chinese President Xi Jinping in October, we saw this run up in soybean futures, yet prices are still near 2020 lows. And Matt and Dani, if we look at the actual data so far, it shows that China has imported about a quarter of its promised purchase commitments under that agreement that was struck when President Trump was in Asia. Of course, though, Beijing has until February to make good on its full purchase obligations.
Yeah, we'll see if some of the big companies benefit as farmers get money in their hand, maybe can buy some deer equipment. Tyler, thank you so much. Bloomberg's Tyler Kendall. Okay, as we head to the end of the hour, a quick check on markets. We're decisively lower, down 1/3%, erasing earlier gains from the open, down 0.2 for the NASDAQ 100, Matt.
All right, coming up tomorrow, Marta Norton joins us from Empower, as well as Scott Cronert of Citi, Ares partner Julie Solomon, and the CEO of Tanger, Stephen Yalof. This is Bloomberg Open Interest.